Are we on the brink of another global banking crisis? The recent slide in global bank stocks has sent shockwave through financial markets, raising fears of a repeat of the 2023 turmoil. But here's where it gets controversial. Could this be more than just a blip, and instead a sign of deeper systemic issues in the financial world? Let's dive in. On Friday, global financial stocks took a nosedive as U.S. regional banking shares plummeted, reigniting concerns about credit quality and the sector's mounting risks. The trigger? Disclosures from Zions Bancorp and Western Alliance, which sparked comparisons to the banking chaos of 2023. Zions announced a $50 million loss on 2 commercial loans from its California unit, while Western Alliance filed a lawsuit alleging fraud by Cantor Group V, LLC. Though Cantor's attorneys denied the claims. These revelations, though seemingly isolated, came on the heels of the collapse of 2 U.S. companies, First Brands and Tricolor, rattling investors already on edge about the booming yet under-regulated private credit market. And this is the part most people miss. The private credit market has seen a surge in borrowing over the past few years, with credit impairments and default rates climbing to 5.5% in the second quarter, according to Mark Dowding of RBC Blue Bay Asset Management. Even more alarming, these defaults have coincided with weaker investor protections, suggesting larger losses than historically seen. JPMorgan Chase CEO Jamie Dimon summed it up bluntly earlier this week. When you see one cockroach, there are probably more, and so everyone should be forewarned. The ripple effects were immediate. European banks led the losses, with Deutsche Bank and Barclays tumbling around 6%, and Société Générale down 4.6%. Asian financial firms, particularly Japanese banks and insurers, also took a hit. In the U.S., the SPDR S&P regional banking ETF fell 2.4% in pre-market trading, following a 6% drop the previous day, its sharpest one-day decline in 6 months. Even tech giants like Nvidia weren't spared, falling more than 3% as fears of contagion spread. But here's the bigger picture. While big U.S. banks have reported strong earnings recently, equity valuations across markets are already sky-high, leaving investors jittery. European bank shares are up 40% year-to-date, and world stocks have risen 16%, fueled by the AI boom. Yet, periodic sharp falls and gains in safe haven assets suggest unease that the rally may have gone too far. Gold, for instance, hit a record high, poised for its best week in over 17 years, while the Swiss franc appreciated as investors sought safety. So, what does this mean for the average investor? The 2023 banking crisis is still fresh in many minds, and the current turmoil has reignited those fears. But is this a temporary shakeout, or a harbinger of something more sinister? Could the AI-driven market surge be inflating a bubble that's about to burst? And what role does the less regulated private credit market play in all this? These are the questions keeping investors up at night. Here's a thought-provoking question for you. With credit risks rising and investor protections weakening, are we witnessing the early stages of a broader financial correction? Or is this just another bump in the road for an otherwise resilient market? Share your thoughts in the comments. Let's spark a discussion.